Hey guys, welcome back to We Talk Money. Man, we are 1 week officially away from the election?
Woo!
Get it done. Get it over with.
Let's just move past
I'm
this,
about
right?
over it.
Yeah. It's going to be an interesting week. Maybe longer. We don't know.
Yeah.
It could extend beyond the actual election date. That's the scary thing.
It looks like, markets haven't really panicked in anticipation of the event. Basically, what's the NASDAQ's flat from like mid-August. S&P also kind of a similar view. Bitcoin had a big breakout over the past week, which is great. We can chat about that. We've got a lot of questions from you guys to cover too.
Nice relative strength in Bitcoin.
Yeah, definitely. I mean, so I think we may have talked about this tweet last week where I was saying like I felt like the Bitcoin was like a slingshot, just ready to snap, and was showing this resistance. And, I've really been loading the boat over the past couple of months. Kind of all these little arrows are my main buy areas. And I was kind of trading in and out around this 10K zone and then built up into basically the 10K area. Once we flipped in from resistance to support, really started to go heavy. And, it was nice to see here on, the 21st, got a snap. And then we're getting continuation right now. We're like, 13.6. So.
Yeah, and basically nice. Speaking on last week, we were talking about the negative correlation. And right now we're seeing a negative correlation.
Yeah.
Which is nice.
Yeah. I think, the decoupling, as we call it, is only going to increase over time. And, I think when there's market panics, like we've said, Bitcoin, stocks, everything kind of crashes together. But Bitcoin is starting to show signs of life and taking on movement of its own. Yeah.
It's awesome to see.
Yeah. Also, this was interesting. So here on Glassnode, you can see that the number of addresses with over $1,000, $100, and $10 is at all-time highs. And I never really looked at the amount of addresses with specific dollar amounts. What I usually have focused on is stuff like this, like addresses with a balance of over 1 Bitcoin, because as the price goes up, the wallets with like $100 or $1,000, those will fluctuate a lot. Where like the real amount that I really like to focus on is like, people that are in between like 0.1 Bitcoins and 10 Bitcoins. What do those addresses look like? And all of those metrics have just been starting to see new all-time highs as well. So definitely really strong on-chain stuff right now.
Yeah, it was a really cool video that you did with Willy Woo, was it the other day? And there were some really interesting metrics that you guys brought up that, as an equities guy, I hadn't really paid much attention to because we don't have those in the stock world. We have our own metrics, but it was cool to see some of the metrics that you have in crypto to look at.
Yeah, it's a whole other set of on-chain stuff that you can see the health and the growth and just the progress of the overall ecosystem. Pretty cool.
Yeah.
We've also got JP Morgan. This is so funny. What was it? Just 2 or 3 years ago, you had Jamie Dimon coming out calling Bitcoin a fraud, and then he was going to, fire any of his traders that even touch Bitcoin. And now they're completely flip-flopping and talking about, I think this is a theme of 2020 is like, Wall Street is really jumping on the bandwagon now. Mm-hmm. They fought it, and now they're just giving in, with PayPal's recent decision to add crypto payments. And, I don't know. The momentum's going. The snowball's going.
I think it's two big reasons why. I mean, there's probably a multitude of reasons, but for me, I think it's 2 reasons. One, they realize they can make money on it. PayPal is like, we're not going to get pushed out by Square. We want to be able to make money on transfers of cryptocurrency between customers. Why not? Let's monetize it. And then 2, a lot of institutional investors finally realize, Bitcoin can be a store of value in a world where fiat currencies are being devalued everywhere. Mm-hmm. And when you look at it that way, and it's, the digital gold mindset, right? Obviously, Bitcoin is more than just a digital gold, but that is a pretty awesome use case for institutional investors. So
yeah, absolutely.
Yeah, their job is to make money for the clients, the clients that they manage their assets. And it's almost feeling a bit irresponsible as an asset manager, for that division, to ignore Bitcoin here.
Yeah, Nikki, I think, Southeast Asia agrees with you because the largest bank in Singapore, DBS, basically leaked that they are also going to be launching a fiat to crypto exchange. So another on-ramp for Singapore where there's a lot of wealthy people and, that just gives it even more leverage in Asia, where we've seen kind of a lot of issues over there with scam exchanges, wash trading, spoofing, front running, all that crap. And I think the more that we get legitimate exchanges and on ramps, that's just going to help the overall ecosystem over time.
Yeah, absolutely.
Yeah. Let's see. I don't want to harp on COVID, but I think it's just important to kind of mention this, with the U.S. recently hitting new all-time highs in cases. I think it's really interesting just to see the divergence between new cases and deaths. Deaths are staying relatively low and or falling over time, where cases are going higher. You guys have any opinions on this?
Yeah, we've also seen a really big spike up in Europe. This is actually something the markets are, or at least they seem to be somewhat concerned with right now, because we've got some new curfews and some incremental measures being taken in countries like Italy, Spain, France, even some U.S. states like Illinois. Colorado is talking about potentially putting in new measures to tighten things up again. So the case increases are a real issue, but like you said, luckily we've become a lot better at treating it in the last 6 months. And so thankfully the death toll is still relatively contained, but the concern is you start to fill up hospital beds and ICU beds. And I know I did see some figures where some of those ICU beds were getting to like 80% capacity in some of those areas where the caseloads are high again. And that obviously poses the question, what happens when they max out again? Then does your death rate start to go up a lot? So it's definitely something that we're keeping an eye on and something to be aware of. I'm not saying we should freak out about it. And actually, like you said, markets aren't freaking out about it yet, but they're a little bit cautious over what's happening here.
I guess it's a waiting game trying to figure out what's going to happen with the vaccine, right? Like, have you guys been following the vaccine stocks at all? Or?
A little bit. And Pfizer, they had an earnings call today, but they really didn't give a whole lot of information about what's going on with the vaccine. And they didn't really talk too much about the data there. So we're still kind of in the dark about what the timeline looks like there. It's still estimated that a couple of weeks, couple of months, that there'll be more concrete announcements.
I think personally that the therapeutics are the key here, because who knows when we're going to get a vaccine that we can distribute to everybody and everyone will actually take it, right?
Yeah.
So my thing is, I'm actually starting to think more about the therapeutic side being the hope for us getting through this, because if we can treat it, I know someone personally that her fiance got it and they treated him with steroids and, they treated him with something else and he came through it and he had a bad case. They're figuring out ways to use the therapeutics that we already have. And then I just saw something today. I can't remember the name of the actual medicine, but apparently there's some hopes that there's a new therapeutic, not the Remdesivir.
Yeah.
I can never say any of these freaking, so I'm not even going to try. But
who comes up with these names?
There's a new one that starts with a P. That's all I can tell you. That apparently there's some hopes that that's going to be good. So I'm kind of starting to focus more on that versus the vaccine.
Gotcha.
Because if we can get good therapeutics, we can get through this.
Yeah.
Right?
Yeah, definitely. And, the biggest thing right now is just getting people comfortable with flying again, going to restaurants, spending money, getting out, right? Yeah. That's what the economy really needs.
Yeah.
Cool. Well, I know you guys are super excited about this one. So Ant Group is going to be the largest IPO ever. Does this matter? Do you guys care? Are you going all in on it? Can you even invest in it? What do you guys think?
I don't care.
I don't care either.
So for anybody that doesn't know, Ant Group is the parent company for Alipay, I believe. And yeah, definitely not a banking or a banking system that we want to put our trust and faith in. But it is interesting that this could be the biggest IPO. Do you guys have any opinions on this, or is it just something that you want to completely stay away from?
Yeah. So, well, for one, it's more difficult for North American based investors because this IPO is taking place in Hong Kong and Shanghai markets. So it would be difficult for us to get an allocation anyway. But these numbers don't really matter. For me, IPOs are all about valuation. What are you buying? How much growth does it have ahead? And I will say Ant Financial has been growing very quickly, especially, shockingly quickly for a company that's already very large. But, the $35 billion number is the amount of capital being raised. And it's sort of like, when we had the Saudi Aramco IPO, just because they're raising a lot of capital and it's a large company doesn't mean it's the right company to invest in. You know, size doesn't really determine whether or not you're getting a good value on your investment. You can buy a really small company that becomes a massive company over time, and that's a better investment than buying an already large company that maybe gets a little bit larger over time.
Yeah.
So I look at every opportunity, you know, on its own, without regard to like what the existing size is or how much money is being raised. It's more to me about like, what's the valuation, what's the long-term opportunity. And Ant's already so big, you know, like I said, they are growing fast now, but you know, I find it hard to believe that they're going to see a ton of success outside of, you know, their home country. But I could be wrong on that, so we'll see. But I just don't, for me, as a North American-based investor, there's a lot of things that I don't quite get about Ant Financial. So it's not for me, but I think in Asia, where you have a better sense of what they are and where they're headed, maybe it makes sense.
Yeah, it is frustrating when you have a company or even a crypto project that you like or that you see prospects for in the future, but it just lists too damn high. Like recently, Polkadot was one that recently got listed, and I forget what the basically the opening market cap was, either 4 or 6 billion. And I'm like, really? Like right out of the gate, it's going to be right there. And then you look at where all the ICO and early investors got in, and when something lists that high, what I've seen over time is usually those will bleed out.
Yeah.
I guess it's kind of the same like with busted IPOs in the stock market, like GoPro, right?
Yeah.
That listed high, it had a couple weeks or a couple months of bullishness and then like a 5-year death spiral.
Yeah.
That's kind of the theme with a lot of IPOs. I mean, we're even seeing that with some of the recent IPOs. I think Asana's been selling off. Lemonade sold off a bit. There are some high flyers too, obviously.
Yes.
Unity's been doing pretty well. But overall, with IPOs, I feel like there's usually an opportunity to pick it up at a better valuation.
Yeah, you don't have to rush to buy on day one, right?
Yeah, unless you're like a day trader trying to catch that first day pop, you know, then maybe that's your strategy and that works. But yeah, for us longer term investors, typically you can get a better price a couple of weeks or a couple of months later as some of those insiders want to cash out. So there's some selling, and you know, it depends company by company. Like Snowflake was one I was hoping to get in at, but it IPO'd at a crazy valuation and has stayed at a very high valuation. So that's one I haven't had a chance to accumulate yet, and I may not for a long while. But
Yeah, it's like when they list high and then they just kind of hang out in flatline, it's like you've got all this dead space below where it could just sink into.
yeah,
It's too hard to tell, like especially at this valuation, the direction from here.
Yeah.
I mean, they could have one bad misstep in a quarter and it could be down 50%. You know, you don't know with these types of valued stocks.
Yeah.
I mean, we just saw that with what was it? SBA?
which one? The
SAP.
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 Well, SAP's been around for a long time, but
That stock had a misstep, and you know this can happen with lots of different types of companies, and especially high flying IPOs can see.
yeah,
They don't
Fastly.
perform well. Fastly was the other one.
Yeah, Fastly is a great example where,
Fastly.
you know, this was a momentum stock. It's up 8x from the springtime this year. I mean, a crazy return in a short amount of time, but then, you know, they didn't quite hit their expectations for the quarter. I mean, it was a very small delta between what they reported and what was expected, and that was enough to send the stock down 30% over a week. So, you know, that can happen to these high flyer stocks with high valuations. And so that's why we like to look at the busted IPOs. We like to wait until the IPOs are a little bit quieter, where people aren't just chasing them because they're the hot thing in the moment. And actually some of the direct listing stocks like Asana and Palantir, those are kind of interesting because those don't get as much hype because they don't go through the traditional IPO process. So we've seen
What's Palantir's ticker?
I believe it's PLTR. PLTR, I believe.
There we go.
Yeah.
Palantir.
So
I always spell that wrong.
it's not necessarily a cheap valuation. I think it trades between 10 and 12 times forward revenues, but you know, for an enterprise software company, that on a relative basis is
That's
actually
not bad.
reasonable. And it didn't have a crazy IPO pop because it was a direct listing. And same thing with Asana, which you
Asana,
mentioned.
yeah.
That's actually been selling off a little bit since the direct listing. So those could be interesting places to poke around when you've got SPACs and traditional IPOs stealing all the attention.
Yeah. I know we've talked a lot about SPACs over the past few weeks. Let's take a look at some of them. How's SBE doing?
SBE is kind of hanging out. You know, a lot of the SPACs have cooled off a bit, especially in the past week. There was some selling. We've seen even one of the Chamath SPACs, which acquired a company a health insurer that people weren't as excited about. That one's actually sold back down to near its IPO price.
What's the ticker on that?
IPOC, I believe. And you've seen some of the other,
Wow.
So you've seen some of the other SPACs trading down towards the initial IPO values as well. SPACs like Jaws Acquisition or Foley Trasimene, which these are pretty well followed SPACs with pretty good founders, and they traded at a premium for a number of weeks and months, but now have come back in, and so things are a little bit more reserved now in the SPAC world, and I think we'll still see like some fireworks in SPACs over the next couple of years, but it's just a little bit of a cooling off period.
Maybe the gold rush is taking a pause for a minute.
Yeah.
Cool. Yeah. So I guess we should talk about the lack of a stimulus deal. So what's the latest on this one, guys?
We got nothing.
Nothing. No help coming.
Yeah.
We still have so many jobs that are lost, from the pandemic, and especially in the service industry, hospitality. I think 50% of those jobs are actually still gone.
Yeah.
And I had a graphic. I should have pulled it up for you, but it was pretty interesting to see it. So a lot of people still need help, and it would have really been nice to get some type of targeted stimulus now to help these people, especially as we go into cases increasing. Restaurants and bars are probably going to have to start shutting down or having, decreased capacity. Again, what are they going to do? They're the ones getting hit the hardest as it is. So it's really disheartening that something couldn't get done.
Yeah, this is a big risk for the market. I'll be honest, because the earnings reports for Q3 have been decent, but the banks and the credit card companies are saying consumer spending actually looks okay. It's growing slightly outside of like travel and entertainment sector, and we don't see any crazy worries about consumer credit going bad en masse yet. But there's still a lot of uncertainty, and there's still like really not a lot of rapid growth in consumer spending. And so we're going to need, if we're going to recover from 9% employment back to the levels we were at pre-crisis, 4 to 5%, then it's going to take the consumer really spending and getting back out there. And right now, this is not going to help. So you've got election uncertainty, you've got uncertainty over if we're going to get any stimulus before the end of the year, including before the critical holiday spending period. And businesses are starting to make plans for next year in terms of business investment. So this is a big deal. The market hasn't really reacted too much, but I think this is a potential risk.
Yeah, and also I guess we're right smack dab in the middle of earnings season.
Yep. Yeah, and so like I said a minute ago, I think we could characterize earnings so far as looking reasonably good, and things continue to improve for most companies from Q2 to Q3, but the rates of growth are not insanely high. I mean, they're modest growth month after month into Q3, and there's still a lot of uncertainty being called out on these earnings calls as to what Q4 looks like, what Q1 next year looks like. And one thing I'll note is a lot of the stocks have not reacted positively to earnings. So looking at companies like Intel, Tesla, even Netflix, some of the high flyers, they haven't really reacted to the earnings reports. Like the stocks are actually down. SAP was down.
Yeah.
Enterprise software company. Now, we do have some that have performed well, like Snapchat, which is kind of an outlier. But for the most part, what we've seen is the stock reactions to the earnings reports have been pretty weak.
Netflix was another one.
Yeah. Those
that
are
was down on earnings.
Yeah. AMD even. Now AMD is, actually reported a really good quarter.
They did.
But then they announced this big acquisition of Xilinx, so maybe that's weighing on it a little bit. But Netflix, SAP, Intel, AMD, Tesla, all down after earnings reports.
Even Intel, I think, had earnings growth and announced more buybacks.
Yeah.
So, I don't know. The reactions have been kind of funky.
Yeah.
Yeah, and like I think you guys were talking about this last week, how the Nasdaq's just been on a rip ever since April, and the risk is now, if there is like just neutral or slightly negative earnings, that this could be a very, very heavy bearish catalyst. It's kind of interesting though that I guess the market's just hanging around all-time highs, maybe just waiting on a deal and or the election and or coronavirus treatments.
I think the market expects a deal.
Yeah.
Eventually, one way or another.
Yeah.
So I think that could be helping the market kind of stay propped up. And then there's, other things like forward expectations of earnings.
Yeah, that's one
that
thing
could
I know you
support.
wanted to bring up What is this chart
Yeah,
showing
so
us?
this is actually JP Morgan put out a report that showed the expectations of earnings going through 2022. Right now, the PE ratio of the S&P, we're trading at around like a 21 forward PE. And obviously, if you look at this chart, which people that are listening, we're very much above the mean. The average is around 16 PE. So we're trading above average, as we know, but there's also the factor of looking into, what's going to happen over 2021, 2022, and earnings are expected to increase over those years. So even looking out to 2022, it puts us at a PE of around 18. So if you think about the market being forward looking, they're thinking, okay, we're going to get stimulus. Okay, earnings are going to get back to normal or grow. We're actually going to get back to what we expected before coronavirus.
Yeah, pre-crisis.
Yeah. But the market might be saying, well, if it could be a case for the market kind of staying where it is or not really seeing like March lows, like some people are still thinking that we might see the market just crash and see March lows again. But I don't really see that as a likely scenario. I think that we could definitely see volatility, but the forward earnings expectations could support the market kind of staying at these levels.
So your expectation is what? Maybe just flat consolidation for several months or quarters?
I'm thinking it's very possible that we'll see some volatility, within, but overall, we're going to kind of stay potentially where we are and potentially even see all-time highs again if we can see stimulus.
Trav, what do you think?
Yeah.
Bull, bear, neutral?
At this moment, I probably lean bearish at this moment. The markets hate uncertainty, and we have more uncertainty than we've had since the springtime when the crisis hit. Longer term, looking out a year, 2, 3 years out, I tend to be more of an optimist. But I think there's although I don't think it's the highest probability that stimulus falls apart, I see some paths where funky things happen with the elections where you've got a split, win between the presidency and say the Senate again. And then you make it more difficult to pass a bill, similar to what we're seeing right now where they can't agree fundamentally on what the package should look like. And so if you have some kind of weird contested election or you have a split House Senate, that just makes it more difficult to get a deal done. So that uncertainty, I think, could be with us. And if they don't get it done before the holiday season, that's a critical spending period. It's a critical time for a lot of businesses. If that doesn't get done and then you have still problems with COVID, what happens if the vaccines don't come through on time with this Pfizer call, the timeline keeps slipping. I'm just glad to be hedged partially right now in my portfolio. And I think there's still a lot of opportunities over the next few years in stock markets. I'm not like a long-term bear, but I'm just trying to be cognizant of the risks here.
Mm-hmm. So you've got some short hedges still working in the futures markets. Mm-hmm. And Nikki, what do you've been taking some profit recently?
That's what I've been doing. Just getting cash ready just in case.
Okay. Cool.
That's my way of hedging
just
right
both
now.
Y'all give me all your cash and we'll just put it into Bitcoin. Done.
I do on Bitcoin too. I mean, I will just be a hodler on that probably for many years.
Yeah. Well, I'll tell you, this is the heaviest I've been in Bitcoin since a long time. Mm-hmm. There's the culmination of just so much coming together, again, the fear and uncertainty and the global economy, which somewhat translates to the stock market. There's a reason why I've just been accumulating and buying on dips and breakouts ever since the panic in March. And, that thesis is playing out. Obviously anything can happen, but I am definitely a heavy bull right now in crypto.
Yeah. I should say this though. It's going to be 2021 is really interesting from a corporate earnings perspective for North America. That chart that you showed with the JP Morgan estimates, a lot of people, what they're probably forgetting is that Q1 and Q2, the numbers looked horrendous for many companies, especially in really affected sectors. Mm-hmm. And the year-over-year change is going to look ridiculous. It's going to be, some of these companies are going to be reporting plus 50%, plus 100%.
Yeah.
And it'll be interesting to see that. And again, I think it does, that probability that things start to really accelerate on the upside is there too if we can get some stability after elections. If we can get a stimulus package done, help the people who are unemployed, and then the snowball starts to roll down the hill again, and people get excited about all these IPOs, they get excited about corporate earnings growth again, and then the market, I think, can get to new all-time highs really quickly. But first,
in the short term, that's where the uncertainty is and where the possible downside comes in.
yeah, well, we've got to get over this hump of the uncertainty.
Yeah.
And then I think if we do get over that and we get some real decent policy decisions made by the end of the year, then I think 2021 springtime could look really explosive. We'll see. I don't know. I see the potential for it.
And I'm definitely, like I said, I'm expecting volatility. I'm not trying to say that I think that it's all going to be peaches and cream
Yeah.
and we're going to see all-time highs. I'm just saying when you look at the earnings estimates and you do, the math on the PE ratio and you look at where we've been and where the average is and where we are now, it kind of, I see the case for us kind of staying at these levels or higher, and not necessarily seeing the case here for a big March sell-off. If we do get a big March-like levels again, I would see that as a back the truck up, load
Buy
up
opportunity.
scenario.
Yeah.
Yeah, the market probably forces the policymakers back to the table at that point.
Yeah.
I've never felt more anxiety. Wait, maybe that's not true. I probably felt this much anxiety during the great financial
You
crisis.
definitely probably did.
But I haven't felt this much anxiety in a long time, and there's going to be a lot of clarity in probably the next 10 to 14 days. But leading up to that, I'm like, I'm like so anxious.
But
I'm
Just
like,
hanging
You
on.
would think that
Yeah.
the market would be reacting a little bit more,
it's not as skittish as you would
it's
think,
not.
right?
I'm sorry, but it's not. Like the pullback we're seeing right now, this
Yeah.
correction of October 2020, it's nothing.
Yeah.
Yeah.
It's really modest. That could change tomorrow. The market could be
could
down
change
5-10% in a day.
It definitely could.
But it is holding up.
But
rather,
why is it holding up so well?
Well.
Like
It's interesting, man.
people will tell you the Fed.
Yeah.
They're not buying equities though, so someone
know,
else is
I'm
buying
just-
equities
I'm
and,
just
and
pulling your
keeping things going. But yeah, Monday,
Print a go burr, baby.
Monday, the markets were down about 2%, and I was like, oh, this week might get ugly. And
It
then,
did look. It was
yeah.
starting to feel a little uneasy
And then
there.
today, it's-
Yeah.
Okay,
As of right now,
maybe
I mean,
not.
it's holding up. It definitely snapped last week's support yesterday.
Yeah.
But we have, again, just a ton of support from September. So I based on this chart, my just, pure TA look at this is like, yeah, chop volatility. We're no longer in the clear trend that we had from April to September.
Yep.
And we didn't get that extension to the downside that a lot of people were looking for off of the high. So we had the peak there in early September, and then a lot of people were calling for fib extensions off of this pullback, but it's just choppy price action at this point. It's like the market, like you guys said, the market's trying to hold up, but with all this uncertainty, it probably wouldn't take much to get another panic. I don't know, man. It's definitely a mixed bag, I would say right now.
Yeah. Okay. I wish I could just
Interesting.
fast forward 10 days into the future.
Yep. Well, in the meantime, we can talk about active versus passive. I know this is something we've talked about in the past, but I thought it would be cool to talk about this again because, the narrative has been just buy low fee index funds, know, don't try to pick stocks. Don't try to be active. And I heard a really good quote from Real Vision yesterday where Mike said, what is it? Passive investing is like driving a car uphill with no brakes. You're good until you're not, until you roll over. And I can see a case where, fast forward a few years from now, it's the active people that are outperforming maybe a flat or kind of choppy S&P, right? Where if you are tactical, you're going to be able to find alpha better than just buying and holding. What do you guys think?
Well, I was actually yesterday, so funny you had brought this up because I listened to a podcast. It was an interview with Bill Bengen, who actually he wrote a paper on the safe withdrawal rate in retirement from your portfolio,
Like
which
the
we now
4%
know
rule.
as the 4% rule, which turns out the media basically put that name on it. It's a really interesting podcast. But basically what he was saying is that he thinks that passive investing has become a cult. And essentially, if you talk to money managers, financial advisors, most of them are taking passive investing strategies, and that's what they're taught to do. That's what they feel is the right thing to do. And if you go to them and say, hey, how about some tactical strategy or some active strategy, they are immediately like, absolutely not. Like, buy and hold, that's the only way.
Yep.
And he was basically saying that he feels that's dangerous because tactical strategy is also helping reduce risk. And so it was interesting to hear his take on it. He's been managing money for decades. He's seen so many different market environments, and he's basically saying that it's a cult.
Yeah. So what are some of the dangers of it then?
Well, as I see it, and this is a very complex topic, but passive investing is really a free rider problem because, passive only exists because of active management. I mean, imagine a world where everyone is a passive investor. Who allocates the capital, and what does that mean for valuations of companies? And does that just mean that all the money gets invested in the largest companies in the world and capital markets get shut to smaller companies and we no longer have IPOs? Or, companies have to like structure themselves in perverse ways to get investment from passive, large, multi-trillion-dollar passive investment funds.
Yeah.
And then in that scenario also, everyone's earning just an average return. And I would imagine the returns get competed away such that everyone's earning like barely above inflation. So it's weird to think about taking passive to the extreme. Passive really can only exist because there are active managers out there. And, so I think passive is right for a lot of people. A purely passive strategy is probably right for people who, don't have access to good active managers or who don't want to deal with it, don't have the time to deal with it. For others, I think active strategies make a ton of sense. And there are absolutely skilled active managers out there. Mm-hmm. And so, and it doesn't have to be purely all passive or all active either. Portfolios can have a good amount of passive exposure, long-term, buy and hold, add a little bit every month or every year. And then you can also do tactical passive investments. Maybe you are really bullish about a specific company. Why not put some capital into that? So I
called
think
a core and satellite strategy, essentially.
I love that, core and satellite. Yeah. Mm-hmm. So there's a lot of different angles to this argument, but I think there's some problems with a totally passive and just accepting that everyone should just be investing in a, some passive strategy.
Yeah, because at that point, all the capital goes to the biggest companies that might not even need the capital anyway. And, I guess in a market where everything's going up and, it just makes sense to just benchmark the S&P. But what do you do in an environment like the 70s or even part of the 60s where there's just a lot of sideways action? Mm-hmm. If you just index that, you're really not doing much. Mm-hmm. And if you're tactical and you're finding, busted IPOs or, whatever strategy, you can really, I think, outperform. I've noticed that over the years. It's like some years the passive stuff will way outperform active. Mm-hmm. And other years it's like, oh, wow, we crushed the markets this year and got a ton of alpha by being tactical.
And I think that there are ways to do passive investing actively, as crazy as that sounds, but it's like essentially there are the thematic ETFs where you can choose ETFs that are not necessarily just S&P 500, mostly weighted in the top 10 biggest companies.
Yeah.
They're actually, weighting a little bit more to social media companies, or they're weighting a little bit more to renewable energy, things like that. And so you're playing the trend, but it's passive because you just buy the ETF and the money manager is going, changing the core holdings as time goes on. You're not doing anything actively, but your allocation is different.
Yeah, and passive is kind of a misnomer in that sense. That's a great point because, if people call passive investing being, say, invested in a S&P 500 ETF, but you're making a choice there to invest in only the largest companies in the U.S. public stock markets. What about other international markets? What about
emerging markets?
Yeah, what about, and so like you are making an active decision, even just investing in a passive S&P 500 ETF. And like you said, now there's such concentration. 25% of the S&P 500 is invested in the top 5 U.S. tech companies. So you're getting exposure actually that's relatively concentrated. So you're making active decisions even when you're allocating to what would be called passive ETFs and things like that. So.
Yeah, I'm a big proponent of both.
Yeah.
if your financial advisor is just putting it on autopilot and putting you in one or two broad market ETFs, you shouldn't be paying them fees.
I agree.
Because you could do that on your own, 100%.
Yeah. So, that's
a lot
something.
of people don't know that though, and a lot of people don't know that advisors are just using either robo advisors themselves, or just those passive investing ETFs that they could do themselves.
And I guess some people just want to know that they're doing the right thing, and maybe it's more of like a coach, like, you know, maybe even on the behavioral side, having even a passive manager can help you not panic at the lows and do all the behavioral stuff.
There's got to be more value than just the buying the ETFs in your portfolio.
Yeah. Awesome. You guys want to jump into some Q&A?
Let's do it.
All right. First question from Alex says, hey guys, love the show. This is Alex from Spain. Hey, Alex from Spain. I wanted to ask you guys about the TV series Billions. If you've seen it, how accurate do you think it reflects the life at a hedge fund? I love this question. Also, what's your view of the recurring topic in the show about the unethical trading during 9/11? What was that scenario? It was Axe did what? He bet against something when 9/11 happened, or profited off of 9/11 somehow.
I feel like he profited off of it. Yeah, I don't remember the exact details because that was like in the beginning, first season, right?
Yeah, I forgot. Yeah, they talk about it throughout the seasons, but I forget what the exact thing was.
I'll Google it while you guys
But
discuss.
Trav, how accurate is the show Billions compared to your experience?
Not very accurate. Not very accurate at all. It's a dramatized series. And frankly, they blur the lines between hedge fund and private equity funds. Sometimes they don't seem to know the difference, which is funny. But, you know, it's a good show. I think it definitely dramatizes. Most hedge funds are actually like very, very boring when you go in and see what people are doing on a day-to-day basis. You know, they're reading, they're doing research, they're doing phone calls and talking to management teams, or we used to go to conferences. Of course, we're not doing that this year. But the research process for a lot of funds tends to be very boring and not very sexy. There's not a lot of like, you know, a lot of the show focuses on like people trying to screw one another and trying to like do these really underhanded things. And that does happen occasionally. And you'll see certain funds, like especially in the distressed world or in the activist hedge fund world, are much more aggressive about that kind of thing. But I mean, most hedge funds are very, very sleepy places, and it's very like quiet and library. Like,
I don't want to believe that. I want to believe that they're in there like fighting and like, you know, taking all kind of drugs and doing really bad things. I don't know. It's just more interesting to think of it that way.
Yeah. You know, the trading desks on Wall Street are probably a lot more like wild with that sort of thing, you know, and trading desks, unfortunately, though, have kind of, a lot of them have gone away. Like equities trading has been essentially made electronic, and a lot of the humans that were involved in equities trading are gone. You know, there's still derivatives trading, interest rate trading, things like that. But yeah, I would say like the trading desks tend to be where a lot more of the like animated stuff happens.
Yeah. Maybe that's flip-flop though, right? From like the wild days of the pit traders and screaming at each other, very physical, to now it's just mathematicians and PhDs, and you know, went from wild to tame overnight, it feels like.
Yeah.
So apparently he short sold the market because he was out of the office when the 9/11 attack happened. So he I guess was able to do that.
That's right. And didn't everybody else in his office die? And then that's how he took over the company.
Survivor.
Oh, interesting. Yeah.
So I guess.
Well, it's funny because 9/11, the markets essentially closed for I think 3 days. So I don't even know that you would have been able to transact, and then immediately the markets were down significantly. So yeah, I'm not sure how accurate that is at all. But you know what? I often think about this. There was a Bond film where I think it was one of the early James Craig Bond films, or Daniel Craig Bond films, and the evil antagonist. What's the right word?
Antagonist, the bad guy.
Yeah, the bad guy.
Yeah.
The bad guy basically, part of his evil plan was to blow up an airplane that was like it was the company was essentially an airplane manufacturer, and they were releasing this aircraft that they'd spent billions of dollars developing, and he was trying to blow it up because he was short the stock and he wanted to make money on it. And I always think about that, like we never see that. Obviously that's a good thing, but you don't see hedge funds like trying to commit terrorist attacks against companies or like, you know, kill executives or anything like that. Like it is theoretically possible, but you know, hedge funds don't do that, mainly because you're probably going to get found out. And
Yeah.
arrested.
It's like, wait a minute, who shorted $1 billion worth of the stock 3 hours before the attack? Like,
these transactions are traceable. So
Yeah.
I always find it funny when things like that are in movies where the financial incentive is done so that they can like profit off of something evil.
Yeah.
It rarely ever happens.
Well, in the show, one thing I think that is actually kind of like real world legit is Wendy. So having like a mental game person like Nikki, you obviously created a course around that and you're on top of the psychology game. Like, did you guys have mental game people at the funds?
We didn't have a full-time person, but we studied the psychology side quite a bit. And so we'd look at books and papers on behavioral psychology. I know trading desks actually do that a lot as well. And they focus on that. They'll bring in speakers, behavioral economists and things like that. So we didn't have a full-time person that like coached us.
Yeah.
But we definitely spent time thinking about it and trying to get better at making less emotional decisions.
That's cool. Yeah, I was talking to our buddy Jared Tindler, who wrote The Mental Game of Poker. He's currently writing The Mental Game of Trading.
Ooh.
Yeah,
Smart.
and he, over the past several years, I guess, has been working with not only just retail traders, but also some trading desks. And it was interesting kind of hearing his experience with
you
that.
brought him in for a live video feed with the community, right?
Yeah.
That was really cool.
He did a class for the wealth building community and talked about a lot of the crossover and also some of the stuff that is not crossed over from poker, like very unique to trading. Some of the experiences that he's seen with like everybody from institutional traders right on down to the guy trading his own capital, right? So it's interesting.
And what's the book that everyone always raves about in the community? I'm like always forgetting.
Trading in the Zone.
Yeah, Trading
Mark
in the Zone.
Douglas.
That's
yeah,
right,
that's
yeah.
another great one.
Yeah.
Yeah, people seem to get a lot of
Classic.
value out of that,
Yeah.
especially the first time they read it.
It explains like why you think the way you do and like, why everybody does the opposite of what's actually profitable.
Yeah.
And until you understand the why behind how your brain works, you're never going to fix the how.
Yeah.
Right. So I always tell people like read the Trading in the Zone first, understand the why and how your brain works, and then read The Mental Game of Poker. And hopefully when The Mental Game of Trading comes out, you can read that too, which is more practical application. Like now that you know how your brain works and why it works that way, here's how you can actually make adjustments to your trading plans and your execution. And, what do you do when you're actually in the moment making buy and sell decisions? So yeah, pretty interesting. Marius asks, BTC is looking bullish as ever. However, do you expect it to decouple from the traditional markets and go up in the case where the virus and other circumstances would drag down traditional markets? So basically, like if the coronavirus hits and things get bad, I believe the question is if stocks and traditional markets go down, do we expect Bitcoin to go up and decouple in that case?
Seems to be happening a little bit at the
Right
moment.
now, yeah.
When there's that initial shock and everything sells off together. But what black swan is there, or what news could cause that again? That's what I'm trying to think about. It's hard to predict black swans.
question.
That's why we call them black swans. But
At this point, I would call it more of a white or gray swan. But if you have a lack of stimulus and then you also have shutdowns, mandatory shutdowns broadly again, I think that would be a pretty bad combo. And you could see a really sharp sell-off in traditional markets.
my hypothesis is that the decoupling is going to increase from here. We can look back like 6 months from now and I might be completely wrong and the markets might all just be correlated still. But my guess is that with institutional money coming in and like we looked at with Grayscale, the momentum is going, right? Like in the short term, any random thing can happen, but I expect that inverse correlation to increase over time. We'll have to look back like 6 months from now to see if I'm right or wrong, but that's my guess.
Yeah, I could definitely see that. And I think it may depend on the severity. If you do get a market decline, I think Bitcoin can actually hold up. Now, if the market declines 40% or 30-40% like it did in the spring, then all bets are off and you probably have a lot of assets going down at once because of liquidations. But if the market goes down 5 or 10%, I think Bitcoin can hold up and absolutely be in that negative correlation territory like we're seeing literally this week.
Yeah. Good point. All right. RS asks, if you were starting from scratch and you had $5,000 of capital, where would you throw it into with the primary goal of maximizing growth? So how to turn 5K into $1 million overnight.
Well, does he want to be active or passive?
That's okay. Yeah. Let's go through that. So again, we can't give personalized financial advice. This is for education purposes only. But, in general, with somebody who's starting with a small amount of capital, what is the decision tree that maybe somebody should go through? I think the first question would be active or passive, right?
Yeah.
Risk tolerance.
Age. Yep.
Other
funds.
Yeah. Are you going to need this money, or are you able to not touch it for years? And are you actually going to be potentially putting in more capital in the next few months and years?
Yeah. Like say you're like 20 years old, you have $5,000, you have a job where your cash flow is say a few grand a month, and you're able to dollar cost average or add into that. That's dramatically different than if you're 65 living on a pension and you need every dollar that you have to live.
Yeah. Like if this person from the financial planning perspective, I would say if this person hasn't even started investing for retirement, then it's a good idea to maybe start that passive-ish portfolio in like a tax-deferred account and take advantage of that. Maybe do some of the thematic ETFs, or try to get. You don't necessarily have to go with like an S&P 500 index fund, but you can maybe start with a little bit of that, and then maybe an active position if you know of a company that you're interested in. That you're interested in now that you think could grow. But with the active stuff, I think it's so important to know what you're doing. And I know a lot of people that kind of YOLO into stocks with their first $5,000 without really understanding the valuations of these companies that they're buying and so on and so forth. And I think the education piece, if you're going to want to do that, is so important.
Yeah.
So maybe I'm a bad person to ask because
well, no. We always answer this in a holistic way, but I kind of want to answer it now in a slightly different way.
YOLO Tesla calls.
Which is, let's take the I guess the most common case here, where it's someone who has, a fresh $5,000 of cash. Maybe they got a little bit of savings they're going to try to put in the next, few months and years, but like they have this chunk of cash and they want to do something with it. And their primary goal is to maximize the growth rate of that capital, and they're extremely open to risk. Okay, here's what I would potentially do in this situation. I would take the $5,000 and I would make some active investments in a few stocks, not a lot. I wouldn't over diversify. I would find a few stocks that I think have the potential to be multi-baggers. I wouldn't buy parabolic tops. I wouldn't touch options yet. I would really try to focus on a couple of really key, interesting stocks, not leveraged, long-term, very large addressable markets. And that's what I would do. And then I would learn from it. And I would try to figure out along the way, like, what am I doing right? What am I doing wrong? How do I continue to stack more capital on this account? But yeah, that's probably what I would do.
Market tuition.
So you would not use options as a way to try to grow that faster?
I could today, after all the experience that I have, and I might, but if I was, say, 20 or 25 years old and this is my first $5,000 bucket of risk capital, no, don't start with options. Don't start with the most high risk, high reward, complicated thing you can do. You can still get really good growth from stocks that can be multi-baggers over the next few years, and try to be really tactical about it without, blowing yourself up immediately and then getting mad, having to start over.
Another way to potentially grow this, to kind of piggyback off what you're saying, is instead of going, I know I mentioned like some type of ETF, you could instead pull out those, some of those top companies, maybe like an Apple or just the really well-known stuff, and kind of pick a few of them that you think are going to be around for a while and just buy those single stocks too. And
so have a concentrated basket of stocks. That's kind of what you were saying too. But like not go after the big names that are already expensive. You're saying go for stuff that has high growth potential over the next 2 to 3 years.
Yeah. I mean, do you think Apple's going to 10x from here? Probably not. The numbers, it's really hard to make a case that it can even do that given the current level of market cap. So yeah, I'm trying to find the next 10 bagger that's under the radar. I want to find the next Square. The next Tesla. Right? Not the ones that have already done it. So that's kind of, and if you don't know how to find those, Well, that's why we have our community. That's why we have our courses. So like,
Yeah.
go spend a couple $100
And
to
learn.
join a community like ours and learn how to do it yourself and
Yeah.
give yourself like the base to be able to do it for the next several decades.
And I'm going to put on my crypto hat and
Yeah,
say,
we didn't even talk about crypto. I was talking about stocks.
So I think it's good to talk about both angles because with stocks, it's either like you can go super conservative and super diversified with ETFs, or you can go more concentrated and tactical with individual stocks. And then you can go even higher risk with options, which is what, the Robinhood generation is all about, options and futures and leverage. And like, survivorship bias really reigns in that space because 999 out of 1,000 are going to lose that 5,000, but the one is going to turn it into 1,000,000. And everybody just wants to look at that person that made the crazy return and got super lucky and say, I can do that too. I don't think there's anything wrong with that as long as you know that the odds are stacked greatly against you and you're not going to like want to jump off a bridge if you lose that 5K.
Yeah.
I know when I was in high school and I was like really learning futures and, I blew out a few accounts and I had to be humbled because I'm stubborn and I have to learn a lot of the things the hard way. Some people, it might actually be good. And I don't know if anybody else really would say this. It's good to blow up early. If you're going to blow up early and get humbled by the markets. But the better piece of advice is learn to survive first and then thrive.
Yeah.
Don't do that. But if you have to, I don't know, do it early.
I kind of lean into what how you say learn to survive and then thrive. Like that's kind of, dip your toe, don't go crazy right away and scare yourself out of the markets.
Yeah.
It's kind of what I think about, especially for newbies.
Yeah. And then on the crypto side, look, Bitcoin, there's obviously a really strong bull case right now for that. Buy an amount that if it goes down by 90%, you're not going to panic out. I've made life-changing amounts of money on altcoins, but again, those are higher risk. You've got timing is everything, not being just a stupid hodler who's tribal and gets into some altcoin and you believe the hype and you just hold forever and then you're down 99% in a year, right? You've got to be tactical if you're going to go into altcoins.
People say they want growth, but a lot of people don't realize the risk though that can come with that.
Good point.
And at least that's what I notice. Yes, I want to YOLO and 10X, buying Tesla, all these big, names that are moving huge, but they don't understand the risk that comes with that they don't have necessarily the stomach yet or the mental game yet to be able to take that volatility or to be able to take that loss.
Yeah.
So
that's a great point. Look at stocks. We talked in the past about, look at Fastly literally this week where it was down 30%. You've got hot money chasing, parabolic tops.
it's down almost 50%.
Yeah.
I think.
Look at some of the cannabis stocks, right? Everybody got super hyped on those and a lot of them are down 90+%. And that is definitely a growth industry, but really you had to understand some dynamics there that were especially problematic if you're buying at the parabolic top on some of these stocks. So
it's funny, by the way, how Canopy Growth, which was one of the most popular cannabis stocks, it looks a lot like an altcoin chart where you get that early accumulation range, you get the first breakout, you get 3 or 4 waves to the top, and then you get the long kiss of death.
Oh yeah.
Like this pattern just plays out over and over in hyped up markets.
Yeah.
So if you know how to do this, you can make a ton of money. You can, the 5K to 1,000,000 and stuff that moves like this, that's where it's possible. But like Nikki,
But you're going to have the strikeouts.
Yeah, you're going to have the strikeouts.
They're going to come with the territory.
And if you're chasing and you're not good, you're going to lose to the people that are skilled.
Yeah.
And are disciplined.
Yeah. I my personal goal is to compound my capital at 20 to 25% a year, and that's a pretty high rate of return. If you compound at that level, you'll be surprised how big the numbers are after 5 or 10 or 15 years.
Yeah.
It doesn't sound like a lot, 20 to 25% a year. There's guys making 50% in a month. Oh yeah, but what's their overall compounded rate over 5 or 10 years?
They're sustainable.
Yeah, sustainable compounding rate, because if your win rate matters, and so does your percentage that you lose when you lose. So you have to understand how the numbers work in this game. Most people can't, especially as your account gets larger, compound at 40, 50, 100% types of rates for more than a short period of time.
Yeah, that's why I think you see on the Robinhood, loss porn, where it's like you see people that do go from a few grand to several 100,000 or several million, and then they give it all back.
Yeah.
Most people give it all back because that's really what that is luck on the front end. And then what that does is it reinforces bad behavior because they're like, I'm a fucking genius. I'm going to go in and I'm just going to make 10x on every trade I make. And then they're like, oh my God, I was up $1 million and now I'm back to zero. Like that story just plays out probably every single trading day.
Yeah. That's why, as entertaining as Wall Street Bets is to read, it kills me inside, you know, because you can just see the ego just coming out of the screen.
Yeah.
And I just know one day these guys are just going to get their hearts ripped out because that's what the market will do to you. You know, every newbie has to pay their market tuition at some point, usually.
Yep.
And so it's just preparing and knowing and doing as much due diligence as you can, and get as educated as you can so that you don't make those huge mistakes and blow out your account.
Hear, hear.
Yeah.
All right. Last question is from Isabel. What is the best long-term stock investment for dividends? So I guess, I don't know, do you guys have an opinion, A, on dividend investing as a strategy, and B, if so, what's a good stock that you would say is a good long-term hold?
Well, look, I mean, with interest rates as low as they are, when you see a stock that has a crazy high dividend yield, you have to ask yourself why. Why does it have such a high dividend yield? There's no free lunch in markets. So if you see a stock that's yielding 15 or 20% annual dividend yield, ask yourself why. And what we've seen with a lot of these high dividend yield rate stocks is the dividend yield is a mirage. The companies actually tend to be in poor financial health, potentially lots of debt on the balance sheet. We just saw, one of the large MLPs yesterday, Energy Transfer, ticker symbol ET. It looked like it was trading at a 15 or 20% dividend yield, and they cut their dividend in half. So a lot of what we'll see when these companies hit high dividend rates is that the market is saying the dividend is unsustainable. And so what looks like a really fat dividend yield is actually ends up being a mirage. And so dividend investing is beneficial, but I think when people focus on purely just the highest dividend yield possible, they end up in really risky stocks. So you have to be careful. Now, there are sustainable dividend yields out there with companies yielding 4 to 5%. And you just have to remember, too, that you're taking principal risk. When you invest in a stock, if the stock stays flat, you'll earn that dividend yield over the next year. But what if the stock goes down? It can wipe out that yield pretty quick.
Yeah.
So for me, I don't focus purely on dividend yield. Dividend is one component of valuing a stock and one component of your total return. I focus on all of the components of total return. So what does the price appreciation potential look like? And am I also getting paid some nice dividend yield that's sustainable along the way? So, we've provided our community members some lists of what we think are relatively safe dividend paying stocks. We have some of the stocks in our portfolio that pay dividends that are pretty nice. But I wouldn't use it as my primary criteria alone for picking stocks. That's me personally.
So in summary, it's kind of like if you only focus on the dividend yield percentage and you're like, oh, that's beefy, but you're not paying attention to the valuation and basically the stock price, you could chase that dividend yield and then the stock price could fall by 50%, wiping out whatever dividend yield you thought you were going to get.
Yeah.
That's exactly what happened to a lot of investors in this MLP over the last couple of years. And frankly, in many energy companies, even ExxonMobil looks like it's sporting a very high dividend yield, one of the highest dividend yield rates in its history over the last couple of decades. But what I think the market is saying here is, and the stock keeps going down and wiping out your dividend, is that it's unsustainable. When you look at the cash flow of ExxonMobil, it's under some stress right now. And the prudent thing for this company to do is probably to cut the dividend in the near term, at least for a little while they can work their way through the low oil price environment. So you just have to be careful just investing on dividend yield alone.
And there are companies that I know that I've invested in that pay a dividend, but there were growth prospects or there was something that was a catalyst for the company's future. So I wasn't, the dividend was nice, but really the combo of a dividend payer with good management and a company that's actually has a lot going for it, something like Walmart for me, Walmart is a dividend payer, a strong dividend payer. They've been paying dividends for a long time and growing their dividend, but my principal, the stock price actually appreciated too because they had XYZ going for them. So understanding the story behind the stock that is paying you a dividend is very important in my opinion.
Yeah, good point. And where did you bought Walmart over the past couple of years, right?
Yeah.
You remember what price you were getting?
I've been buying it since like the 60s and 70s. But
maybe back in 2018 or so?
Yeah, it's been when Amazon was going to take over the whole, grocery store industry is when I started buying it.
Yeah.
But the thing about it is it had a story. It had potential to do more than just be like a Verizon that's just kind of been, Verizon is a pretty popular dividend payer, but it just the price just stays flat.
Yeah.
Oops.
So
let me pull that up. What's the ticker? VZ.
Yeah. So know what you're looking at there. Now, obviously, Verizon is a very steady, stable company.
Yeah.
That's probably going to see steady, stable profits for a long time. But are we going to see? Is there a growth story here? That's going to help propel the stock price. I don't know, maybe, but that's just what I would say is look into the quality of the company and make sure that dividend is going to stick around. And there's also other catalysts that could help you boost your returns.
Yeah, agreed. Cool. Yeah, dividends are kind of like icing on the cake, I think.
Yeah.
Nice. Yeah, a little juice to the return. Are there any that come to mind that might be a good play that has a growth story with a dividend right now that you can think of off the top of your head? Not to pin you down.
I know I'm going to get hate for this, but I mean, Apple is definitely not cheap right now.
Yeah.
But it's not that they're not growing, and it's not that they don't have potential future catalysts, and it's not like they're not going to be around for a long time. And I expect them to grow their dividend. I expect 5G phone sales to be a catalyst for them. I expect their services sector to continue to grow. So I'm not mad at Apple for their dividend and as a solid company to own, but you get exposure with that through your S&P 500 index if you have one of those. There's definitely probably other places to look to.
Some of the higher dividend yield stocks that I own are what I think they're really undervalued, and they actually already have a pretty nice dividend yield, like Macerich, right?
That's a good one.
I mean, this is one that is not without risk. However, I was aggressively buying this in the single digits. It hasn't really gone anywhere this year yet. I think it could potentially double or triple in the next year or two, assuming the right things happen economically in the country. But
you've done some deep dives on this on your YouTube channel that are just fantastic.
Yeah.
What's the current dividend yield on this?
I believe it's about 10% annually based on the current rate, but that will likely go up because over time they should be increasing their dividend again. This used to be they were paying a $3 dividend prior to 2020. So, the dividend yield on the old dividend would be like almost 50%.
Wow.
But they probably won't get back to $3 of dividends annually, though. I think they can get back to maybe $1.50 or so. Mm-hmm. And that would that would still be a very, very high yield on today's stock price. So I think this one has upside in terms of stock price, but you're also getting paid a decent yield to wait, I think between 8 and 10% based on current rate. But this one is on the higher risk end of the spectrum. Mm-hmm. So
yeah, it kind of depends what your risk profile is with this type of dividend investing.
Yeah.
Because I can think of plenty that are higher yielding dividends, but there's risk associated with them too.
Yeah. CenturyLink, or what is it now? Lumen, I guess. LUMN. That's a 10 or 12% yielder, but has a lot of leverage on the balance sheet. But it's definitely on the higher risk spectrum, but it has upside, I think, both in terms of stock price and dividends. So,
Nice. Well, guys, anything else y'all want to talk about before we wrap it up?
We've hit on a lot of good topics today.
Yeah.
I feel like we had some good, we overwhelmed people with difference of opinions with with the way to invest. I think it was good to hear the different strategies. There's so many ways to invest.
That's what I love about the markets. And it's kind of a catch-22. It's like you can have whatever opinion you want, and for liquid markets, there's always somebody willing to sell to you and buy from you.
Yeah.
So there's always action available. It's just, are you right? Right. And when are you right? Are you right before the masses, or are you right, but it's already too late? All these factors that play into this game of investing is just so fun. And I think it's good to show the differences in our opinions, and why I've been outperforming this year, basically being in crypto. Hey.
Oh,
That's right. That's right.
but the risk.
What risk? Bitcoin to the moon. No,
So let me ask you guys this: how are you going to keep your sanity over the next week before I guess, and during the election?
Stay
the TV off.
Social media. Stay off social media.
Yeah.
Yeah. For
Yeah,
sure.
that's good. I think exercise, not
Work
being-
on eating healthy again.
Yep.
Trying to lose the COVID 10 that I
COVID
gained.
30 in my case. Yeah. What about you?
Yeah, same. I think try to avoid as much negative external influences from media stuff, although I have to be somewhat in it because we're in markets, so we're always making sure we're on top of news flow. But
Yeah. Just have reggae music playing in the background. That makes everything better.
Yeah.
yeah.
All right, guys. Well, thanks for watching today. Don't forget, go to wetalkmoney.com, submit a question for the show. Leave us a review on iTunes, too. I know a lot of people are watching this on YouTube and listening through like Spotify and different apps, but if you know anybody that could get value, make a recommendation. Send them our way. And yeah, we'll see you guys next week. Take care.